Hi, I'm Batkay, and today I want to talk about why tax diversification matters more than you think. You've probably heard the phrase, don't put all your eggs in one basket. Most of the time, we apply that to diversification and investment ownership, such as owning stocks, bonds, or maybe something alternative like real estate or precious metals. An often overlooked form of diversification that we should consider for our investments is tax diversification. Tax diversification simply means spreading your money across different types of accounts or buckets that are treated differently by the IRS. In brief, these include the following. Pre-tax retirement accounts like 401ks, traditional IRA, you get a tax break now and you'll pay the taxes when you withdraw funds in the future. After-tax retirement accounts like Roth IRAs, Roth 401ks, you pay the taxes today, but the funds grow tax-free and withdrawals are tax-free later. Taxable accounts, like a regular brokerage or investment account, where you can access them anytime, but you'll owe taxes on dividends or capital gains. And then there's charitable vehicles, donor advised funds, which can reduce taxable income while supporting causes and missions you care about. Now, if you're a spreadsheet kind of person, you might be wondering, wouldn't it be more efficient to just mathematically figure out the best bucket for today and put everything in there? Here's where planning for the future comes in. The truth is, we don't know what future tax rates will look like or what our own income will be in the future. A great way to mitigate the risk of this uncertainty, much like our investment portfolio allocations, is to diversify. By diversifying across tax buckets, you're giving yourself optionality. And optionality reduces stress and provides flexibility in the future. So let's take a few scenarios. Imagine a retiree who saved everything in a pre-tax 401k. At age 73 or 75, required minimum distributions kick in, and suddenly they're forced to pull out more money than they need, pushing them into higher tax brackets and maybe even increasing taxes on their Social Security. Now picture someone with a mix of pre-tax, Roth, and taxable accounts. And each year they can decide which bucket they want to tap, balancing their income to stay in favorable tax brackets or take larger distributions dispersed across the different tax buckets. Or take a charitable giver. If they've built up an appreciated stock in a taxable account, they can donate shares directly, avoid paying capital gains, and still support their favorite causes and investments. And in a market downturn, someone with a taxable investment account can avoid drawing down depressed pre-tax accounts by balancing capital gains and losses, or only selling stabilizing investments like bonds, to give their investments time to recover while drawing essential income. The point is that tax diversification isn't about perfection. It's about flexibility and optionality. So here's the takeaway. Think of tax diversification as having a toolbox instead of just a wrench. Will every tool be equally efficient in every situation? Likely not. But having options means a greater possibility to adapt to whatever life, tax policy, or whatever the markets throw our way. That flexibility doesn't just save money, it can give us peace of mind, because in the end, financial freedom isn't only about numbers. It's about confidence, control, and the freedom to live generously with expectations. Thank you for watching this video. Please be sure to give it a like and subscribe and tune in for our next episode of Coffee and Cash. Thank you.